Okay, hello everyone. I'm here with David Ryan, and we're going to go over a topic uh, about valuation and how it relates to super performance in stocks. And we're going to give you just some perspective. Like I talked about earlier, we're starting off with just some overall perspective, and then we'll be narrowing it down and getting much more specific as the days go on and as the curriculum goes on. But right now, we're going to talk about valuation, and most of the workshop, we're going to talk about the things that we do and exactly how we do them, precisely how we execute various strategies. But we're also going to talk about, particularly in the beginning here, well, some of the things that we don't do and the reasons behind that. We're going to start off with valuation. And when we talk about valuation, I'm really talking about the PE ratio. There's other ways to look at valuation, but basically, we're not looking at book value and things like that, that a value investor would look at. We're investing and trading growth stocks. So we're interested in growth and we're interested in momentum. And that comes in the form of earnings, sales, margins, and the chart, relative strength, the chart, and just some moving averages for smoothing and trend. Um, so, Dave, with valuation, just open it up right off the hop here. Um, I know some people will stay away from a stock if it's trading, at a certain PE multiple or a PE above the general market. So, say the market's trading at 20 times earnings, the S&P 500. Are you reluctant to buy a stock that might be trading, let's say, 65 times earnings, three times or more the market?
No, no, because these stocks are growing a lot faster, and a lot of analysts don't can't even get their hands around how fast these stocks are growing. And one of the basic characteristics of of this approach is that growth stocks are valued at a much higher PE ratio than other stocks. I think the average was 2 to 2.5 times the P ratio of the S&P 500 was found in these growth stocks. So if you were right off the bat going to eliminate stocks that had a P ratio twice the S&P 500, you would be eliminating a lot of the greatest winners of all time. I mean, I would think almost all of them.
Yeah, Dave's referring to the biggest winning stocks. Of course, when he was at O'Neill, they did a lot of studies looking at the biggest winning stocks. I've done the studies myself. I've mentioned Richard Love, who did studies back in the 60s and 70s. And we've all concluded the same thing, basically, a lot of the same characteristics with these growth stocks. But one thing is for sure is that you get what you pay for. You're not going to get a Ferrari for a Hyundai price. And we're going to show you this right now. And we're not going to spend a lot of time. This is going to be a short section, but it's impactful to be able to see how these stocks discount growth. And I want to start off with taking a look at Yahoo back all the way back into 1997 when I first started buying Yahoo. And at the time, I was advising institutions, some of the big hedge funds and mutual funds, and I would take them, ideas from time to time of my favorite ideas. And at this particular time, the internet stocks were some of my favorite ideas at that time that I was very bullish on. And I took Yahoo to some of the big institutions, and they said, "Yahoo, never heard of it. And are you crazy? It's trading at 938 times earnings." So I was buying the stock right here in 1997. We're going to get into that later. We'll take a look at what that looked like up close. But you can see it was 938 times earnings, and then a few years later, the stock went up 8,000% in just 2 or 3 years, and it was trading 1,700 times earnings. And interestingly, by that time, the same people who didn't want to buy it when I brought it to them were looking at it then, and everybody started looking at those names. And then, of course, we had a top not too far after that. So, when I find also when you're looking at biotech stocks or some kind of new technology that's maybe misunderstood, that the PE ratio is completely irrelevant. And also, even if it's trading at a very high level, it usually works itself out, because if you're growing, some of these companies are growing at 100% per quarter. And if you just do the math, you can see how quickly a PE ratio of 100 times earnings will be 20 times earnings if you keep reporting those quarterlies. Um, the cheap trap. This is something where not only do you have to be careful of the cheap trap with PE ratio, but also with just price hitting new lows or with buying on the way down. And the reason why is if you buy a stock because it's cheap, that's the reason why you buy it. Well, what happens when it goes lower and you're down 20 or 25%, or God forbid, 50% or more? It's cheaper. It's actually more attractive, right? Based on the cheap rationale. So you get trapped into the stock of thinking, wow, if you loved it at 60, wow, it's a bargain at 30, right? So, and if you take a look at some of the worst blowups in history, they all start as being cheap and looking low relative to where they historically were trading. This is just looking at AIG when we had all the, the blowups there. Dave, was there any circumstance whatsoever, fundamentally, if there was just, this, everything is getting hit, the banks and their big, names like, whether it's Bank America or Morgan Stanley, is there any way that you would buy a stock that is, plummeting like this, and throw out the rules of buying at new highs or buying stocks that are strong?
Yeah, no, this is, I mean, especially as the stock has gone down below 50, you now have, it looks like 8 years of overhead supply in that stock.
Sure.
And so, I mean, just looking at the chart itself can just, within a second, I can say, there's no way I would be looking at this stock. I don't care how low the PE got. Basically, no, I would never even be thinking of buying this.
Of course, I know the answer that Dave's going to say, and I wouldn't either. So, but we're trying to make the point that, you really have to get away from this idea of, buying bargains if you want to buy really great merchandise. And we'll talk about this more, but just remember, every major correction, every 50% or even 25% decline starts as a pullback, as a minor pullback. So you need to treat these pullbacks as potential big declines, and that's where cutting your loss comes in and so forth. But the thing that you want to understand is two things. One is that a stock can get cheaper and cheaper and cheaper. And with the PE ratio, there's really only two ways that I do use it at all. One is if it's exceptionally low. So let's just say the market's trading at 20 times earnings and you've got a stock that's 4 times earnings. That's usually something very strange and could be especially if it's hitting new lows. It could be heading to bankruptcy. So I would be very reluctant to buy a very, very low PE. And the other way is looking at PE expansion, which we're going to look at later. That's when you're selling at a profit, and we'll look at that later. But you can see here, taking a look at GE. Now, here's a company that's one of the biggest companies and the highest quality company in the world. And look what this stock went down, right, in the 08, 09 bear market, from above $40 down to virtually a penny stock, down over 90%. So there's no such thing as a safe stock just because it's a high quality name or it's a name that you're familiar with. Now, another thing that people sometimes don't quite understand, even if you understand it intellectually, or you understand the math behind it, people think that you buy a stock, it's gone down 50%. How much more can it go down? 100%. Well, it's gone down 90%. How much more can it go down? 100%. It's from where you buy it. So a stock can go down 50%, go down 50%, go down 50%, and keep cutting in half over and over and over again, depending on, or 90% over and over again. It's from where you bought the stock. So if a stock goes down 90%, it doesn't mean that it only has 10% more downside, or it's necessarily washed out. That doesn't mean that. Let me get my pointer too. Let's see here. Thought I was able to. Can you see my little spotlight here? Because I thought I was able to use that.
I can see it. Do
Oh,
I?
there it is. Okay.
Yeah.
Yeah. And you have one too. I don't know if you want to use it, but you have you go up to annotate, and then it gives you the toolbar there. Of course, using Zoom here. So I want to show you a few things. All right, some real life scenarios. And here's Crocs. It's a stock that I was in made a big move. It went up 400%. And the thing that's interesting is you can see that before it makes this giant move up, it's trading at the highest PE that it's traded at in its lifetime. And before it went down 90%, it's trading at its lowest PE. Okay, so again, and then of course the valuation got even lower and lower, and it's a bargain this whole way, right? No, it's not. There's something wrong there, something going on, and again, so this stock just completely ignored this high PE, and as the stock moved higher, the PE actually contracted more. I want to show you a stock that David and I were both buying right to the day. As a matter of fact, I bought some a few days earlier, and then a few days later, I doubled up on the position, and Dave also bought it. It was Ollie's bargain outlet. Dave held it through most of this big move here. I traded in and out of it a few times. But the interesting thing to look at here is look at the PE ratio before, right when we're buying it. It started off, it was up around 140, and then it came down a bit. And then when we're buying it, it's up around 100 times earnings. And then the stock goes up and runs up about 300% in 30 months, and the valuation is much lower. So you might ask yourself, well, how does the stock go up 300% and it's cheaper than it was down here? So Dave, why is this stock much cheaper, but it's advanced so much? It should be more expensive, no?
No, well, what has happened is that the earnings are growing so quickly that the PE ratio is actually contracting. The stock is going up slower than the earnings are going up, but that's what's creating the move, and that's why the PE has dropped from over 100 times down to 48 times, and the stock has gone up. Look at that; it's gone up almost 5 times from that spot.
Right, right. And when it was trading at 140 times earnings, and you see that the PE works itself out, and the earnings are growing faster than the stock is actually moving. So the stock can keep going. As long as those earnings keep coming out, the stock could keep moving higher. As a matter of fact, a stock that I bought, Taser, and this stock, of course, made a huge move. Actually, let's look at this chart right here. Sorry, I skipped my page. When I was buying it right here, I mean, it looked pretty high, right? I mean, it was up 12-fold in 7 months, and it was trading at 230 times earnings. And I'm buying it right here as it's coming out of this power play. And then if you fast forward and you take a look where I'm buying, you can see it was actually, in hindsight, it was quite cheap. And you can see the PE ratio each time, like over here where it moves into new high ground, you've got a PE ratio that's up around 250 times earnings. Then here where I'm buying it, it's actually a little bit lower valuation. Then it expands a bit. You can see the PE plummets here, and it's even much higher. It's up about a double. And now the PE ratio has cut way down because, again, the earnings are growing faster than the stock is moving up. And then later on, after the stock's up 500%, the PE is right back to essentially where it was, trading at that high valuation that seemed so high in the first place.
Yeah. And one thing I would like to add is now this is not to say, okay, you go out and you buy every high PE ratio stock that's out there. I mean, there's going to be so many other characteristics that we look for, but you want to see a stock that's in an uptrend. You want to see those earnings in an uptrend, or the sales in a strong uptrend too, as all this is happening. But if you see a stock that's rolling over and has a high PE ratio, that's that's not a reason to buy it. We've got so many other characteristics to go through to lead you to these great stocks.
That's right. And really the main point is that the PE ratio is really a gauge of sentiment more than anything. You're going to have high PE ratios in the market, in bull markets, lower PE ratios in bear markets. You're going to see PE ratios that range from 20 or 30 times earnings to 1,000 times earnings. And you're not going to really know whether it's a good value or not, because growth stocks that are growing very fast, there is no appropriate PE multiple. You can't really put a PE multiple on a stock that's growing 200-300% a quarter. So again, the real point is to really just ignore the PE ratio and to look at the earnings, the sales, the margins, and the stock price itself, the price action and relative strength. and like I said, some moving average for smoothing, which we're going to get into later on. I want to show you a few more things here on the valuation of the PE ratio, and to make this point, Apollo Group, you can see, and again, when a stock is in its own earnings cycle and they're reporting really great earnings, even in a tough market or a sideways market, you can see amazing progress. You can see here Apollo moved up 200%, while the NASDAQ was in the throes of a bear market and basically moved sideways for that whole period. But the interesting thing is when Apollo started making this move, it was trading at 60 times earnings. And then after it went up 200%, it was still trading at 60 times earnings. But now here are your annual EPS. This is what they reported each year. If you take 40%, 45%, and 55%, take their 3 annual earnings, and you compound them, guess what it comes out to? 200%. You see? So basically, the stock just moved with the earnings and adjusted as the earnings came out. It went up 200%. The earnings came in 200%, and the PE stayed the same. Now, another thing, one thing that I've noticed, and I've noticed this for years and years, or decades actually, and that it's what I call the broken leader syndrome. And basically what it is that you'll have these leading stocks in each bull market. And this happens to me all the time when I'll be at the gym or something. And, after a stock that was a gigantic leader in a bull market back in the 90s, it was the Cisco's and Dell Computer and, US Surgical and all these names that Amgen that made these huge moves, Qualcomm. Later, after they topped, and this is a perfect example of one right here, which you can see made a huge move from 20, more than a tenfold move, then came crashing down. It's down 75%. And right about here, this is where I hear people in the gym coming up to me and saying, hey, I just bought, some Cisco, it's down 80%. How low can it go? It's a great quality company. This was one that's, everybody knows about now. See, that's where you got to be the most careful, and that's where you don't want to own these. The problem is that when they're making these big moves, usually they're names that you haven't yet heard of. When I was buying Amazon in '97 and Yahoo in '97 and even Walmart back in the '80s, there was very few people who knew what Walmart was. Sam Walton was standing on a soapbox in front of the stores, trying to get people to come into the stores, if you can imagine that. And Walmart was trading 10 or 20,000 shares a day. It was like a very small cap company, and I was buying the stock then. And now today it'll be some other name that you haven't heard of, and 10 or 20 years from now it might be an institutional favorite company that everybody loves and wants to own. But the best days are behind it then. So if you see here, after the stock's down, you can see the PE comes in, right? But then you see here where it comes ripping back, and now as the stock is even lower and the stock comes way off its highs, you'd think that it's cheaper, right? No, actually what happens is now the earnings start coming in because the stock discounts it. The earnings start coming in, or I should say stop coming in, or maybe even losses get reported, and then the PE just soars, but the damage has already been done. So, again, after a 90% decline, your valuation here now is 3 times higher. Okay, that might strike some people as strange, but that's precisely how it plays out all the time. I can show you example after example. Here's Lumber Liquidators, where again, most expensive before it makes a big move. Stock comes off, has a big break, it's topping, and now it looks cheap. You see, but look at this, comes off 90%, and then after it comes off 90%, then all of a sudden the PE soars. And Dave, explain, why is that? Why is that soar like that?
Well, it's because the stock has come down, but the earnings have now started to drop. They've already gone through their big growth cycle, and they're going up against great big numbers, and their earnings are starting to slow down, and that's what causes that PE ratio to now jump higher. The other thing to think about too is you might think it's cheap, but even after that stock has been cut in half, there are a lot of people above you. So let's say this from 120 down to 60, you've got all those people who have bought the stock that are going to want to sell if it rallies back up anywhere close to where they bought it, because they're sitting at a loss. They've already lost money, and that constitutes overhead supply. That's just one more reason not to buy after a stock has a great fall, and even if its P ratio is now lower than where it was before.
Right. You have several things. First of all, you have a lot of overhead supply. So you've got trapped buyers that are in the stock. So if it happens to rally back much, it'll meet selling very quickly. And because the stock is broke so hard and you see these big down moves on big volume, it's telling you that institutions are getting out of the stock. And that's the exact opposite of what you want to see and what you want to piggyback. You want to be in the stocks that the institutions are actually buying, not selling. All right, so this is, like I said, just an overview to really sort of debunk, I guess, the PE ratio idea, or the valuation of looking. A lot of times people say, "Oh, how could you buy that stock? It's trading, at 300 times earnings," and sometimes they don't even have earnings. You'll have a stock trading at 300 times earnings, and it has no earnings, but it's a biotech company. So now it's trading on the future prospects of a drug that, who knows, might be a multi-billion-dollar drug if it gets approval, and smart money is betting on it, and that's what's moving the stock. So you just don't know for sure that the valuation game is very difficult. You can sometimes apply the valuation to slow growers. If you have a very slow growing company, you might be able to use valuation, but when you start getting into that fast lane of really powerful, dynamic new leadership companies that are growing at a huge rate of return, there's just no way to value that. And I can tell you right now, the CEO himself doesn't know where that stock is going to be, or what kind of valuation should be on it, or where those earnings are going to go, a year, 2 years down the road. No one knows. You just sort of have to play it quarter by quarter as the earnings come in. All right, so we're gonna take a break and come back, but I just wanted to go through that. This is, like I said, one of the few areas that we just give you some perspective, some overall perspective, and as we narrow down, we go from that satellite view, that real wide view of giving overall perspective, down to an aerial view, and then we're going to keep zooming in, where we go to an overhead review and then get very microscopic and look at things really under the microscope, and get very specific, right to the very day that we're buying or selling. So this will progress over each session here. So we're going to take a break right now, and we'll be back.